Hello and welcome. You're watching Business Plus, the afternoon edition here on News 9 Live. I'm Krishna Kumar and I'm being joined by my colleague and friend Suyash Maheshwari in the studio. And as always, we begin this afternoon edition of Business Plus with a check on how Indian stock markets fared for today's trading session. Indian stock markets, Sensex and the Nifty off to a decent start. But then towards the last couple of hours of the session, falling deeper and deeper into the red. Wasn't that the case, Suyash?
Exactly, Krishna. Now, after a flattish opening, Indian markets succumbed to selling pressure, but the big fall, Krishna, came nearly about in the last last hour of trade or so, just as the 10-year treasury yields hit 5%, which was a level last seen in 2007, just before the credit crisis in 2008.
So you mean the US treasury yields?
The US 10-year treasury yields have hit a 16-year high of 5%. Now, why is it such a big deal? I think we should explain that. The 10-year yields is a key barometer for mortgage loans, auto loans, student loans. So when the bond yields rise, it can significantly impact the borrowing cost for businesses, consumers, as well as the government. Now, second is that generally the spike in bond yields make the government debt more appealing compared to stocks, as investors factor in a higher cost of doing business by companies. And apart from the 10-year treasury yields, of course, there is the conflict that is going on in the Middle East, which unfortunately is far from over. And I mean, Krishna, now it's not only a humanitarian crisis, but it's also turning into a financial crisis, since the entire Middle East region, where the war is expected to spread, at least how things are looking, is responsible for nearly 1/3 of the entire world's oil production. And talking about oil now, Brent crude over the weekend has softened slightly, but it is still hovering at an uncomfortable level for us, which is around the $92–93, especially for India, because we are net importers of oil.
All right. So those are the factors that impacted the cause for the crack in the market in the afternoon session of trade. We also have Mr. Rohit Srivastava, founder, Strike Money Analytics and Indiacharts, also joining us. Rohit, thank you so much for taking time out to be with us. We'll just come to you. Suyash, also tell us, it's a day in which Sensex and Nifty both have lost nearly 1.5% in the red, and you're seeing that red falling into mid-cap and small-cap indices as well. Talk to us about them and, of course, the big sectors that were hit in today's trading session.
Certainly, Krishna. So, the last tick for Nifty came in at around 19,281 mark, which is down about 1.34% for the session. Now, this is the lowest level since August end, and with today's close, Nifty has extended its losing streak to now about four sessions. Sensex, on the other hand, fell nearly 825 points and closed below the 64,600 mark. Now look at the advance decline ratio, Krishna. I mean, about 457 shares advanced for 2,893 shares that declined, which means that nearly almost 6 stocks fell for every one that rose. So the overall breadth of the market has also deteriorated quite significantly. Now the broader markets, Krishna, the bloodbath continued over there. Nifty mid-cap 100 corrected by over 2.5% and fell to a 2-month low. Nifty small-cap 100, on the other hand, was worse off. It was down about 3.5%. Volatility also saw a spike of about 0.8%, with India VIX closing in at 10.91%. Now, among sectors, Krishna, it was a sea of red. Nifty media was the worst hit. The sector was down about 5%. The metal pack was also down by about 3.26%. The PSU banking pack, Krishna, despite the early resilience that we were seeing in the banking pack, Nifty PSU ended today's session down about 3.77%. Talking about banking pack, Nifty Bank, which was pretty much, hugging that trend line for the majority of the session, also saw a sharp decline in the last hour of trade and closed down 1.3% at 43,151 levels. I mean, the only sector, Krishna, that I can see that did not fall 1% was Nifty FMCG, which corrected by 0.8%. I mean, on any other day,
they're not called defensives for nothing. Even in this market, you see that Nifty FMCG pack falling the least. And that's why, ladies and gentlemen, the traditional conventional wisdom is that you put money in FMCG stocks and defensives, you lose less on a day in which you see others bleed. Look at Nifty Media, PSU Bank, Nifty Realty, Nifty Metal, all down anywhere between 2.5% to 5%. Incredible a sea of red over there. This takes to Rohit Srivastava, founder Strike Money Analytics and Indiacharts. Rohit, what a day of trading it's been. Not many expected this kind of an ending. And how much are you spooked by that 16-year high of US 10-year Treasury bond yields, hitting after 2007?
So those are multiple questions. One thing is to be spooked and one thing is to be prepared.
Okay.
But we got spooked, I think, in the last 2 weeks itself, and more so in the last week, because just remember that just last week the small cap index actually hit an all-time high, but it was not confirmed by the mid cap index. Simultaneously, the US VIX actually shot up to 21%, so that was a multi-month high. And as you've already mentioned, bond yields again continue to move higher without any intervention from the Fed, which means that even though they're oversold, they're continuing to give us a signal that something's not right in the bond market. But I'll tell you, apart from all of this, what is really worrying right now, at some point of time, we would have thought that weakening inflation data could have caused the bond market to bounce back, and then markets could have eased a bit. What is happening though is that because the Fed is staying on the course of higher for longer interest rates, it is actually beginning to slow down the US economy. Now, where do you really look for a recession signal? You look at it at something known as the yield curve, which is the difference between the 2-year and 10-year bond yields. And that difference between the 2-year and 10-year for almost a year has been inverted. But the inverted yield curve tells you that you're getting into a tight situation, but it doesn't really predict the recession itself. So most of the recessions actually happen after the yield curve starts to steepen and specifically go above the zero mark. Now that has started to happen over the last 2 months. The steepening has started, and that is what is spooking the US stock market right now, and has actually tipped it over to a point where you would really take all your bets off that market. Now, what that really means is that if the yield curve is signaling a potential US recession coming in the next couple of months or maybe over the period of time, markets will start pricing that in much sooner. And I think that is what has started. So that process has spooked first US markets. And I think finally it has spooked the Indian market, which was still trying to hit new highs. But now we are beginning to see that unwind. So I think people should be worried, because unless you can really get out of this, the downside risk increases significantly, because a US recession can really mean that the S&P topples more than 20%, which is a very significant number if that event really happens. And then are you really prepared in terms of your portfolio positioning to handle an event of that kind? And what would be the impact of a 20% US market decline on the Indian markets then becomes the next big question that we have to try and answer.
Now, Mr. Srivastava, Fed Chair Jerome Powell is due to speak, again on October 26. Now, in his last speech, he sounded rather dovish, talking about the strength of the US economy. However, without saying it outright, Mr. Powell also said that, the focus will be on bringing back the inflation to the long-term target of 2%. Now, I have two questions over here. Can the Fed really afford to, go for another hike, given that the interest rates, the 10-year Treasury yields have climbed to a 16-year high? The second is that 2% inflation target even realistic in this economy?
So understand the Fed funds rate is already, above 5%. So all that has happened is bond yields have just caught up with the Fed funds rate. Now, there's a very old theory that, the Fed follows the bond market. And right now, it looks like the bond market has been behind the Fed. So if the bond market actually started to signal lower rates, you would have seen the Fed starting to cut as well. But that has not happened. So in that sense, what will end up happening here is if the yield in the market and the Fed funds rates are at the same level, they might actually end up doing nothing, which is sort of what he said in his last speech very, very recently, that, they would probably just leave rates where they are and leave probably one future hike on the table, which means they may not raise rates at this moment, but they'll not remove the possibility of raising it just in case. Right? So that doesn't really change the main point which he said, which is leaving rates higher for longer, which is if you keep interest rates at a very high level for a prolonged period of time, even though you may not be cutting them, you're not really stimulating the economy. And so what it does, it does hurt future demand. And in that sense, it will lead to a slowing down of the economy.
So then what's the way out for Fed? I mean, from your words, it looks like Fed is in a bit of a soup here.
One way or the other, damn it if you do and damn it if you don't.
Yeah, they've gotten themselves into a corner, that is for sure. And we would have hoped that they would see that, because the US does have a very large borrowing program. And the bet that the market was trying to take, why the markets were elevated despite rates moving higher through the early part of 2023, was that the markets were betting that at some point of time, if inflation comes down, the Fed will back off from its rate hiking program. Because it has to fund the treasury that's going to borrow trillions of dollars to fund the government. So it's a circular trade. And if that has to happen, how are they going to do it? And so the market was betting on that, but it doesn't look like the Fed wants to give in till it has enough reason to do so, which means you need a crisis. Now, you always need a crisis for them to really change their mind. And you don't have one yet. The last one was the banking crisis in March, and they did put a backstop to that. And now we are simply waiting for the next one to show up. So till the time the next one shows up, if they don't back up on yields, they end up slowing down the economy.
Now that you're talking about crisis, there are many, from the likes of Robert Kiyosaki to even Ray Dalio, who are talking about an impending crisis or an impending crash, except that we could be possibly better prepared this time around as compared to 2008. The only reason why I'm asking this question is because that year is ominous. We're talking about it on a day in which US 10-year Treasury yields have hit the levels they've hit in 2007. We all know what happened in 2008. So my question, and there are talks of an impending crisis/crash happening in the US. I want your thoughts on that. At a time when the high interest rate cycle looks like it's going to continue forever.
Yeah, so it may not continue forever, but for the time being, you're right, the rates have reached similar levels. The reason they haven't caused the same calamity yet, now that is the first question to ask, is because a lot of loans, especially housing loans, were actually refinanced by retail at large when rates had really fallen to 2-3%. So a lot of the housing loans have been refinanced at those very low rates, which is why these high interest rates are not really leading to delinquencies or bankruptcies like they did in the housing bubble. So that's one thing which got taken care of. On the corporate side, similarly, a lot of corporates also reduced their debt levels. So these issues are not propping up. The real problem is now with the bond market itself, that if yields remain high and the bond market is falling, who's the largest holder of bonds? And it ends up being banks. And the banks are the ones that have taken the biggest hit. You can see the US banking sector being one of the biggest underperformers at this moment of time. And that pressure remains. So some segments of the market will get hurt by these high rates.
Now, Mr. Srivastava, what sort of a spillover effect can we see from the correction in the global markets, in Indian markets? If you can, give us some guidance in percentage terms.
So, in fact, I was actually surprised that in the recent RBI meet, the RBI actually talked about selling bonds. Now, Indian bond yields were actually not rising since June of 2022 when they touched around 7.6%. So that's more than a year that bond yields were actually down, and which was really helping the market conditions and also creating hope that yields in India will actually head much lower, which was also my expectation. But this has come as a surprise, wherein bond yields then have started to rise in India as well. Now, why did this happen needs to be questioned. It also creates some question mark around, is this a risk, currency risk management, step that they have really taken. Now, coming back to a number, see, we can start by being conservative, saying, fine, this will blow over, the Fed has to change its policy. If that is the case, then we'll have a minimum normalized correction down to maybe 18,800, 18,100 as a worst case scenario, which is around, say, 61% retracement of the entire rally that we've seen from the March bottom. So 18,100 could be that worst case scenario in a normal condition, which means, we don't get into a recession. They take some steps to backstop it, and, we're back to normal. But the risk, like I said, is on the table. The yield curve is pricing in the potential that a recession is coming. And if that is the case, and you have to really prepare for that, then you should be prepared to see much lower levels. Who knows, a retest of the March lows of 16,800 is something that we should mentally start preparing for. Whether it happens or not, of course, depends on the events. But since we've actually had a very good rally in the market, it's good to really at least get rid of things like excessive leverage, speculative stocks that people own. That's where you get killed the most, when you get these kind of reactions like you're seeing in the mid and small caps today, and that you need to really protect yourself from and move away from.
All right. We have multiple questions in our heads that popped up. Both me and Suyash. Let me just begin and then you can first continue. One is, did you just say we could be back to March 2023 levels? We are in October. If we are going to be back to March 2023 levels, when are you expecting this to happen? Is my first thoughts. How soon do you expect this to happen? Before we end with the calendar year or the financial year, or which one are you talking about? And Suyash, you had some questions in mind as well.
Yeah, I mean, if you're factoring in a 6 to 10% correction, I mean, would it be prudent to really book those profits, as you were saying, from speculative bets? Like this broader market, the kind of run-up that we have seen, I mean, will it be prudent to book those profits from the broader markets at this point?
I think some level of de-risking. See, I'm not saying that we will go to back to the March lows. The question was that if the US heads into a recession, then that becomes a possibility. The problem is that we are often unprepared. There are two approaches one can have. One can say that, okay, I'm sure this won't happen, and therefore I will not take these actions. The second one is that you see a possibility of something, and then you prepare accordingly. See, I can sell something today. I can always buy it back if it goes down to only 18,000 and it looks like the world is normal. You're not going to get a recession. Things are not going to slow down, and fine. We are all good. The problem is that if you try to decide after it breaks 18,000 that, oh my God, we are getting into trouble now. Shall I sell? My understanding is that most people would be unable to do so emotionally and psychologically. It's not that you can't pull the trigger, but most people cannot, because they're not really trained to really handle markets that way. We are just trained to save, invest. We are working somewhere. We are not financial market experts or professional traders who can, get in and get out at the drop of a hat. So which is why it actually makes sense for a lot of people to book gains to some extent. Everybody can decide what extent that is. Should it be 20% of your portfolio, 30% of your portfolio? But if you create some degree of cash in a good market at good levels, then it definitely gives you the room to maneuver when things are much lower. Not only to re-enter if that is a possibility, and also if you feel later that, okay, I need to cut further, it will be much easier for you because you've already done it once at a higher level and reduced your downside risk. So I think some kind of action is definitely called for, without really saying, when this happens, because, recession can be 3 months. See, markets can fall much faster than the event itself. As the market starts pricing in the possibility, it will start dropping month after month. December is a seasonal period where sometimes markets can be at a peak or a bottom. So it's a good point to think that we may complete some kind of a minimum worst case scenario we may end up seeing by December, whatever that number is. So maybe December is a good place to even review whether the worst is over at that point of time.
So given the kind of uncertainties that we have talked about in nearly the last 20 minutes, what would be your advice to the retail investors? How should they navigate the market at this point in time?
So I'll end up repeating a bit of what I said. First is deleverage. I don't know how leveraged each one is. Some people do borrow money and buy stocks. So leverage is something that you should seriously reduce, because that's what gets into trouble immediately, because it causes double X drawdowns when markets start to decline. The second is one place where I have significantly reduced exposure is newly listed companies, IPO'd ones, because they've not really been through a bear market. Sometimes do take a hit, and they don't have enough history at the beginning. So any stock that has been, not listed for more than a year or two is something where I would, and if there have been gains, I would actually book out and think about it later. So these are the kind of steps that one can actually think about. But broadly, creating some level of cash, 20%, 30%. Usually mutual funds don't build more than 5-10% cash levels, but portfolio managers and PMSs do sometimes go up to 20-30%. And that's what individuals can actually do, because they're not restricted by any rules or guidelines. That create some level of cash that makes you comfortable, that if there is a market dip, one, you have ability to re-enter at that point of time, so you have cash to deploy, and you're also able to decide whether things are going to get worse and you need to take further action. So I think start by actually creating some level of cash based on your own risk profile.
Start by creating cash is the word coming from Mr. Rohit Srivastava, founder of Strike Money Analytics and Indiacharts. I'm going to thank Mr. Rohit Srivastava at this stage. Thank you so much for taking time out to be with us here on Business Plus on News 9 Live and helping put the carnage for the day into perspective. Hope to keep having you again and again on the show. But for now, we'll let you go. Thank you so much. And thank you, Suyash, for taking time out to, of course, put the markets in perspective as you do every single day. But time now to shift our focus away from the stock markets to the big story that we're tracking here on Business Plus all through the day. The campus hiring freeze that is going on as far as India's IT sector is concerned. Infosys and Wipro, two of the top four Indian IT giants, are choosing to sit out the campus placement season this time around. So the class of 2024 engineering graduates in India are set to have it tougher than it was before, because it used to be TCS, HCL, Infosys, Wipro. Now, no Infosys, Wipro, just TCS and HCL, and they too are not doing the kind of numbers they used to. Bear in mind, Infosys and Wipro alone put together have hired over 2 lakh people over the last 3 years. So they are a big source of jobs and livelihoods for the first jobs of India's IT graduates. How is the year 2024 going to pan out? Because the story here is that none of these companies are set to go on campus for placements up until March 2024 at least. So what's going to happen in the meanwhile, and what's going to happen post that as far as India's IT jobs are concerned? And to take things forward, we have Mr. Prabir Jha now joining us live on the show, founder and CEO of Prabir Jha People Advisory. Prabir, always a pleasure to talk to you. We've discussed the Indian IT sector threadbare on many counts. This time around, it's all about those first jobs. The first jobs of engineering graduates, so important. The youth of India that needs to be gainfully employed. India's IT sector, the biggest employer, 2 of the 4 IT giants are not going to be on campus.
Krishna, thank you for having me on your show. And yes, it is a matter of concern, but it is of no surprise. I think on a similar show some weeks ago, I had talked about this, that the sentiment is weak. And the hiring by IT majors has actually turned full circle. I mean, I remember 20 years ago when I was in HR in now what is one of India's frontline IT companies, we would hire almost or make offers 18 months before they passed out of campus. And now comes a time when you don't even know whether you'll have a job 1 year after you've finished. It also means that IT companies have become more prudent, have become more risk averse, and are looking at campus programs more tactically than strategically. Because a near freeze, a near boycott, either means that their own belief in what the future of the next 18 to 24 months is going to be is weak, or they are very tentative. And therefore, they are not going to be putting good money behind a bad opportunity. First point. Second point is that, for freshers from campus to be truly productive, it does need a 6-month odd kind of a time frame. So very clearly in the near term, they do not expect business to be strong enough to even absorb potential attrition, which the fresh hires could have met. From the campus program or the campus perspective, yes, it is a dampener. But, I always have believed that, every crisis turns out to be an opportunity. Let's look at it this way, that IT will be the biggest employer was in a way partly reality and partly the hype that got created. So while many other sectors, many other people who did engineering in many diverse areas, everyone got absorbed in one industry called IT. I think it's just that potential reset of campus hiring is going to happen. Instead of only looking at IT companies, product development companies, potentially there is an opportunity for people to start looking at career starts very differently. Now, that reconfiguration can sometimes be painful, hurtful, can cause agony, anxiety, but who knows? With hindsight, maybe it's a better thing to have happened, both for the individual and for many other industries. So the gloom and doom is more, at least at the moment, hyped. I think it's going to be an opportunity for many other sectors to visit campus, for many other companies, including in the so-called IT space, to look at it. But yes, I think salary levels and very rapid fire campus hiring program and batches getting placed, I think that's not going to happen, at least for now.
Right. There has also been concerns, that 2024, or the year that's going to end in March 2024, is going to be a washout year for India's IT sector, and that has also resulted in numbers, if you see the workforce as a whole contracting. So the question here is that, if the class of 2024, for them, will it be better that they wait up until March, that something, things will ease up post March 2024? Or, talk to us in the job market per se. How does one approach the job market in a situation like this?
Yeah. So, if I had to counsel, and I get these kind of queries from a lot of people on my social media handles, and, I personally think it's not good enough to hope and that things overnight will get better. I don't think. The geopolitical reality continues to be uncertain. Crude prices continue to be kind of climbing. I think also with the US getting into an election year next year, we don't know. So I think it is better to be looking at other alternatives, other options, and try and have something to keep you busy. Because when you are not picked from campus, I think it's not the end of the road. But I know from my experience of talking to youngsters and my own hiring experiences in the past that there's a lot of demoralization, potential depression, and that is not good for a youngster. I think there's always something that in today's world you could do, and situations sometimes get you to think differently. So my exhortation will be not to be just hoping for a miracle to happen, but actually to be more prudent, look at other sectors. There's a lot that is happening within India Inc., except that the nature and nuance and possible compensation levels are going to be a little different than what we may have expected when we started, our college programs. So be practical, be pragmatic, but just don't be blindly hopeful for a miracle in the short term.
Don't be blindly hopeful for a miracle in the short term, is the word coming from Mr. Prabir Jha. Prabir Jha, before we let you go, also talk to us as a whole. India's IT sector is the linchpin as far as satiating India's requirement for jobs for young people is concerned. But overall, if you see, do you see this also impacting other sectors and their hiring plans per se? Because the way the global economy is, forget the fact that the IT sector is facing its own set of specific challenges, but what about the other sectors, the overall hiring scene as far as India Inc. per se is concerned?
So, I think it's a little too early, but I am among those who believes that, India is only going to remain strong. And I believe that there will be an opportunity for many more sectors and companies to start visiting campuses and hiring in general. I think at least in the last some months, I have not felt or sensed when I talk to companies in other sectors that, they are not looking for good people. Everyone seems to be expanding all the way from metals and minerals to healthcare and everything in between. The challenge is very artificial. Talent has scoped what it believes as its dream sector. And a lot of that is because of the stories we've also created. And some of the sectors have actually been unsung possibilities and opportunities. So I believe that the opportunities will come their way, and employment will generally be seeing an upward demand. Now, whether people actually take that opportunity or sit back and therefore create an artificial unemployment crisis, that we will have to wait and see. Because I think even the talent world wants a certain of sardine packed in a certain can for it to be devoured. I think that is not going to be the opportunity. It is going to be more, it's a classic demand supply economics of talent, Krishna. And if people are practical, I think there are enough number of jobs, enough kind of jobs, and nothing is the end of the road. start somewhere. Who knows, a year later, 2 years later, you can always come back. And even IT has in its heydays gone and hired people from diverse backgrounds and experiences because they needed, pair of hands to kind of drive the agenda forward. So just don't sit back and hold your head down and stay depressed. Explore the opportunities, all kinds of jobs. Don't get stuck that, if you don't get a campus job with a top IT major right now, it's the end of your career. Careers don't get planned and done in such tactical fits and starts.
Right. Prabir Jha, founder and CEO of Prabir Jha People Advisory, giving the perspective on, putting this into perspective for us on how we need to approach that job market for all those watching this broadcast. Prabir, as always, such a pleasure and a joy having you put things into perspective for us. We'll let you go at this stage, but thank you so much for being with us here on Business Plus on News 9 Live.
Thank you.
Now, away from the IT sector, let's get into some macros at this stage. Guess who has become India's biggest trade partner? And that is the United States of America, beating China by over $1 billion for the April to September time period. You have the US with over $59 billion of trade emerging as India's biggest trading partner in terms of value, albeit the fact that both India's exports to the US and India's imports from the US both have declined in the recent past. In fact, the overall value of trade between the bilateral trade between India and the US is actually down by over 11% as compared to the same period in the previous year. And yet, the news, the big headline that's emerging from all the trade data that's been published by the Commerce Ministry of India is that the United States of America has now beaten China to become India's biggest trading partner. The bilateral trade between India and China too declining by over 3.5% to just about $58 billion. There too you see India's exports to China and imports from China both declining as compared to the same period in the previous year. And yet the news that emerges from it is that as far as India's bilateral trade or trade partnership with the US is concerned, it could hit into positive territory very soon, despite global uncertainty and challenges that is bringing the overall import-export numbers down. And of course, India's measures to mitigate as much of imports from China into India, and in general trading relationships with China. So a pattern emerging there, US becoming India's top trade partner. Exports to US, bear in mind, was down to $38.2 billion during the April to September period of the year 2023. And imports too were down. Two-way trade in India, China down by 3.5%. China was, bear in mind, India's top trade partner from 2013-14 till 2017-18. And then back again in 2020-2021 as well. China retaining the title of India's primary and biggest trading partner. And before China, it was the United Arab Emirates, UAE, which is India's biggest trading partner. But now all that's forgotten, because now we have a new leader, and that is the US. We have Teresa John, Deputy Head of Research, Lead Economist at Nirmal Bang, now joining us live on the broadcast. Teresa, thank you so much for taking time out to be with us here on Business Plus and News 9 Live. Talk to us, both imports, exports between India and the US declining, and between India and China also declining, and yet the US emerging on top as India's biggest trading partner.
So I think broadly the picture that's playing out is, I mean, in terms of positioning, US and China in terms of top trading partner, they have been, kind of switching places over the last 2 years. So, I mean, going by the first half data, I wouldn't read too much into that, but a clear trend that is emerging is some of India's exports to the US, particularly in the first half of FY24, have done quite well, particularly in the non-traditional sectors. So like smartphones exports to the US have seen a sharp pickup. It's up nearly 500% year on year. Similarly, even sectors like the photovoltaic cells, you've seen a sharp pickup on a year on year basis. Even as we've seen some slowdown in traditional sectors like chemicals and gems and jewelry. Overall, we've seen a situation where India's exports to the US have fallen at a slower pace when compared to the fall in imports from the US.
Right. As you are telling us, there is also clear policy measures and efforts being made by India to make sure we import less and less from China. And in fact, India depends lesser and lesser on China as the world is moving away from China as a primary trading partner. So in that sense, this would further the efforts, and the way the numbers are going, the bilateral trade between India and US could grow into the positive territory as well. So that's a more clear, as we go forward, that picture will emerge very clearly, won't it, Teresa?
Yeah, I mean, there is a possibility that exports could pick up in the second half, but I mean, that really depends on the US domestic demand situation. I mean, if the US goes into a recession, then you could see some slowdown across the board. And so it's not a given that the exports could pick up in the second half of the year. But yeah, India's dependence on Chinese imports is coming down. I mean, we still are dependent on China for a lot of machinery, even consumer durables. But that dependence, particularly on the consumer durables side, and even in products like toys, plastic articles, etc., because of the deliberate policy, that is coming down.
Right. So India's dependence on China is coming down. The question here is that how do you see the trade between India and US flourishing or even improving at a time when the US is risking a recession going forward, and especially at a time when the high interest rate cycle is set to continue even further in the US?
So, I mean, one way that India could have an advantage going forward is like if you've seen in products like, as I said, smartphones, etc. India could have a cost advantage, and that could continue. So probably in those non-traditional sectors, you could see continued growth. But I mean, I don't think India is immune to a US recession because we do have nearly 17 to 18% of our exports going there. So these non-traditional sectors can contribute, but I think it's difficult to say that you will see a very meaningful pickup, even if we go into the positive territory in terms of India's exports to the US in the second half of FY24.
All right, Teresa, the one other thing that comes to the mind at this stage is the question of GSP, or Generalized System of Preferences, and the benefits that accrue from that. The US needs to reinstate India into its GSP list so that the Indian exporters to the US can benefit from that, and this number can grow further, isn't it, Teresa?
Yeah, so if you look at GSP, so Generalized System of Preferences, that was in force till June 2019. India was one of the biggest beneficiaries in terms of GSP. So I think there were about just over $20 billion of imports that came into the US under GSP, and nearly 25% plus of that came from India. So to that extent, India's exports kind of benefited from the GSP. But we've not actually seen a meaningful fall in exports, because GSP was removed. So if that is reinstated, I think there will be certain sectors that could benefit, probably iron and steel, plastic products, maybe to some extent machinery and gems and jewelry, to some extent organic chemicals as well. But what remains to be seen is whether the overall export trajectory, I don't think we'll see a meaningful change, even if GSP is reinstated, but there certain sectors could definitely benefit.
Right. That's the word coming in from Teresa John, Deputy Head of Research, Lead Economist, Nirmal Bang. We will leave it at that. Teresa, thank you so much for taking time out to help put these numbers into perspective. And as you're rightly pointing out, can't be misled by these numbers. You need to understand these numbers in perspective at a time when both exports and imports from and to the US and China are declining as far as India is concerned. But definite change in the trajectory of who is or who's going to be India's biggest trading partner in the days going forward. And before we wrap up this particular edition of Business Plus, there's an important story we want to talk about, and that story has been doing the rounds on all your social media feeds all through the day, and that is about the owner and executive director of the Wagh Bakri Tea Group, Mr. Parag Desai, who unfortunately passed away at the age of 49 after a fatal attack by some street dogs. Mr. Desai, who was out for an evening walk outside his residence, fell and he suffered from a brain hemorrhage as he was trying to escape these street dogs. Bear in mind that this attack happened on the 15th of October, and Desai incidentally passed away at a private hospital in Ahmedabad on the 22nd of October after being on the ventilator for over 7 days. Bear in mind, Desai was the 4th generation entrepreneur of that premium tea company, Wagh Bakri, and was a leading tea industry voice, and a prolific tea taster himself as well. His last rites were conducted at the Taltage crematorium this morning, and here we, at this point, on that somber note, I'm afraid we've completely run out of time here in this particular edition of Business Plus. Thank you so much for watching. You can, of course, catch all the stories that we're covering here online, on YouTube, on X, on every social media platform possible. Make sure you subscribe to us. But for now, thank you so much for watching. This is Krishna Kumar signing off. Keep it with News 9 Live.